Have you ever asked yourself, wow, how do all these billionaires make their money? Like take Warren Buffett for example, he's got to be a genius to accumulate this amount of cash, or is he? This video will show how easy you can make this kind of money, so you can become just like him, in like 50 years or so. Warren Buffett's strategy is all about value investing, popularized by Benjamin Graham. Value investing looks at the intrinsic value of a share rather than focusing on technical indicators, such as moving averages, volume, or momentum indicators. Determining intrinsic value is an exercise in understanding a company's financials, especially official documents such as earnings and income statements. To guide him in his decisions, Buffett uses several key considerations to evaluate the attractiveness of a possible investment. Companies that have been providing a positive and acceptable return on equity for many years are more desirable than companies that have only had a short period of solid returns. The longer the number of years of good return, the better. In order to accurately gauge historical performance, an investor should review at least 5 to 10 years of a company's return on equity. Having a large ratio of debt to equity should raise a red flag, because more of a company's earnings are going to go towards servicing debt, especially if growth is only coming from adding on more debt. Instead, Buffett prefers earnings growth to come from shareholders' equity. A company with positive shareholders' equity means the company generates enough cash flow to cover its liabilities and is not relying on debt to keep it afloat. For Buffett, low debt and strong shareholders' equity are two key components for successful stock picking. Buffett looks for companies that have a good profit margin, especially if profit margins are growing. As is the case with return on equity, he examines the profit margin over several years to discount short-term trends. To stay on Buffett's radar, a company's management should be adept at growing its profit margins year over year, a sign that management is also good at controlling operating costs. Buffett considers companies that produce products that can easily be substituted to be riskier than companies that provide more unique offerings. For example, an oil company's product, oil, is not all that unique because clients can buy oil from any number of other competitors. However, if the company has access to a more desirable grade of oil, one that can be refined easily, then that might be an investment worth looking at. In this case, the company's desirable grade of oil could be a competitive advantage that helps it earn profits through greater sales and margins. This is the crux of value investing, finding companies that have good fundamentals but are trading below where they should be. The greater the discount, the more room for profitability. The goal for value investors like Buffett is to discover companies that are undervalued compared to their intrinsic value. An opportunity to buy at a discount exists when a company's current market value is cheaper than its intrinsic value. While there is no exact formula for calculating intrinsic value, investors will look at a variety of factors, such as corporate governance and future earnings potential, to estimate intrinsic value. Warren Buffett has many investing principles, but one of the most important he stresses is investing in yourself. He has stressed that making yourself smarter and wiser can help you become a better investor. He also believes investing in yourself includes having good financial practices, such as not overspending beyond your means, avoiding credit card debt, saving, and reinvesting your profits.